Here's our Forex blog for August 2nd, 2011. And like most days, we really want to buy the strong pairs versus the weak and sell the weak pairs versus the strong. Today, the weakest one throughout the day was the Australian, and the daily, weekly, monthly trends down. And so that's the best one to sell. The yen is the stronger of the dollar versus the yen, and the daily, weekly, monthly trend of this is up, whereas the monthly trend of the dollar is still down. So basically, and also the Swiss is strong. So you can sell the Australian Swiss, or sell the Australian yen, and it's the highest odds probabilities all day. As you look at this currency right here, it rallied up yesterday. It was underneath the hourly, broke from below to above the hourly, which is a bullish sign, went sideways, and broke back underneath it. And from then on, the currency meter showed you to sell it. And it was a very high probability currency to sell. The new version of our software has range bars, and you can go in here and say 6R for 6 pips. Every time there's a 6 pip movement, it creates a new bar, and it gives really high probability, low risk, and very defined small stop loss type trades. Notice as this starts to fall, and because it's range based, if the market does nothing, as you can see here from this hour right here, there's very few bars. Once it breaks underneath this, and you can also see farther back in the chart, once it breaks underneath here, you go short. You might get out on the first bar that goes green, or the first bar that or the first tick above a bar that goes green. But there's a lot of very low risk, high probability trades. When you spot a trend, and the Australian yen was one of the better ones, you can look for a 2, 3, 4, or 5 bar of green up, and the first bar that goes red, you go short. So you would basically go short right here on the close, with your stop right above the high. You're risking the tiniest amount, and as you can see, this trend just continued. You can also, as we've done for 5-6 years in class, draw your trend lines underneath the bars, and when that breaks, go short, which would pretty much be the same level. In this case, it would be short right here, and you can see it kind of went down. There's a lot of different high probability trades when you are trading the strongest versus the weakest. In this case, the weakest versus the strongest. And usually once the trend starts to begin, you can anticipate a Fibonacci area as being the end of the move. And when the price does get down to the fib level and it has this little sideways rectangle, you can also oftentimes do a counter trend trade when it breaks out. Anything more than 5 bars up, down, up, down, up, down. After 5 bars, a breakout of that is usually high probability. And if you miss that one, you have barely this one right here as well, and you can see it went up about 30-35 pips. You also, after that very nice pullback, because this trend was so weak, could spot another very high probability trade here as well, and easily pick up 10 to 22 pips. Let's look at the Australian Swiss. Weak Australian, very, very strong Swiss, and you're going to have the exact same thing. Let's scroll back here, and this might be a higher volatility one. We might want to use more distance per bar, but just look at how smooth the patterns are. You have a strong trend down, 2 bars up, 1 bar down, you go short. Very, very tiny risk. And the key to trading is small losses, bigger wins. And when you're risking such a tiny, you want to put your stop a pip to 3 pips above there. When you're risking such a tiny amount, and you're using a currency meter to find the strongest currencies, and in this case, you're short here at 84 or 85.45 with about an 8 pip stop, maybe plus the spread, and it fell 25, 35 pips. So you made 3.5 times more than what your risk is. And then, in this case, you have many bars up, and you never know if that's the end of the move, but it kind of chops around, fails to go over that high. You might also go short here. If you're not in here, another 2-bar pullback is right here. You have wicks at the high of the bar. Wicks oftentimes are a reversal signal. Anytime after you have like 5 or 6 bars of one color, you have a bar of the opposite color with a wick underneath it. Typically it's a reversal. Notice the wick here, and here, and here. These 2 wicks right here, all the wicks right here. The wicks are an amazing system. Notice the wick back here at the end of that move. You know, especially after you have a very clear trend like this, you don't know if it's going to reverse right here, but the wick right here, you might just decide to go short right here. Pip underneath it, 85, 40, or 34. Your stop is, in this case, I guess about 20 pips because it's a little more volatile than most. And, you know, it works very well with Fibonacci profit target levels. Notice almost to the pip. Great place to get out. And if you weren't, you know, if you're not an aggressive counter trend trader that maybe went long right here, you can see it went up about 25 pips. The double bottom at a fib target after such a big move down usually is a pretty high probability trade. Range bars are brand new in the chart, and you can switch from, let's say you had a 5-minute bar up here. And notice the difference between a 5-minute bar. Where would you have got into this trade? I mean, would you have really felt comfortable taking that trade right here? I don't think so. I do like the same trade right here after it kind of had a nice pullback and went sideways. But notice all the distance here from 330 to 8. It just kind of went sideways. And, you know, remember what this looked like on the tick chart. I mean, not tick chart, but range bar. 330 to 8. You know, it's a little bit clearer. You know, this kind of went sideways right here. You might have sold the low here. It didn't go lower. You might also draw your fibs on this and sell the fib target right here, somewhere between here whenever it reverses. You got a nice little 20 pip reversal. You got the double top here. And it's usually risky to sell a triple top, so I wouldn't sell that. But once it goes underneath this swing low right here, somewhere right here, your stop's initially above here. It kind of works its way down. You might have got out with a small profit. As it shoots up here and kind of stalls, you might have also shorted right here with your fib target off of this last wave, giving you a very decent profit target versus your tiny risk. Anytime you risk 10 or 15 pips, or with more volatile pairs like this, maybe you might risk 20 pips and trade half the number of lots you do on euro dollar. It's a good way of trading. Notice also here at 7 to 7:30, the CAD became really weak, and the longer term trend is down. The dollar was relatively strong at that point, stronger than the yen. You could have traded the CAD against the dollar at that point, or against the Swiss. You want to buy the dollar excuse me, versus the CAD. So this has to actually download a ton of tick data for it to work. And notice, you know, when the market's dead from midnight until 6, there's very few bars right here. You see that? And it's very clear what's going on. Notice the 5-minute chart. Just a lot of noise, a lot of ugly looking charts. Go back to the 6 pip chart. So the market, you know, was trending down, broke a trend line, came down and retested from the other side. That's usually a sign that the trend's going to reverse. You might, you know, have went long here and maybe made a few pips on there. But when it finally broke out, you have a very high probability trade. You can clearly see this area was resistance, 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 and then it broke out. And if you weren't in that original trade, here you have that exact trade I was talking about. After you see a big move up or down, the first 2 or 3 or 4 or 5 bar pullback, red and then green, and you just go long right here with your stop just a pip, you know, 1 pip above here. As soon as it goes over that bar's high, you're risking 6 to 8 pips. And you already know ahead of time what your profit target is, your Fibonacci area. Notice to the pip. I mean, you know, if you don't use fibs, there's something really deficient in you, and you must not want to make money. And it helps you define what your risk is versus your reward. Right here, if you bought this at 93, your profit target is up here at, let's say, around 17. You know, you have a potential of 25 pips. It doesn't always go to the fib target. Sometimes it just goes up to the high and comes down, and you might have a 3 to 5 pip stop, or loss, or break even as it kind of comes back and you decide to get out. But you're risking, you know, maybe 8 pips to make 25. That's a 3 times bigger win than you're risking. At that rate, if your wins are on average are 3 times bigger than your losses, you know, and you're right only 40% of the time, you're going to make a lot of money. And notice on this pullback here, let's say you wanted to get in on this trend right here. You got in it, you know, 3 bar pullback, green, wick, you're long, you know, and when it comes underneath the low, you had a loss. You know, you might go along here again, it's kind of chopping around, you have another tiny loss. You know, 2 losses, really only eats up half that profit you made on this trade. So you're right, 1 out of 3 times and you're still up about 10 or so pips. And the fact that it failed to continue the trend, and obviously at 9:30, the currency meter is not telling you, 9:30 it's not the weakest one anymore. And guess what? At 9:30 the dollar's super weak. So, a smart person using our tools would not have even looked to buy it. You'd be looking to sell it because now you have a weak dollar. Unfortunately this one's weaker too. You're better off selling the dollar versus the Swiss, after 8. Let's look at after 8 for the dollar Swiss. Super weak dollar, ridiculously strong Swiss all day. It's a no-brainer, And looking at this chart today, trending down, and trend lines also seem to work better on these. When trend lines get broken, oftentimes you have a reversal. You have another trend line off the lows here that got broken. And a lot of times when trend lines get broken, you have a retest right here. But it's a pretty high probability trade after 8:30 to sell right here when it breaks underneath the low. And it has a nice trend down. Here's your first 2-bar pullback up, first bar down in the direction of the trend. You go short with your stop right above the high, and you also have your Fibonacci profit target of this entire wave down here. You're risking 7 or 8 pips with a very good chance of making 25. And guess what? You did. And if you wanted to get out of half your trade here and put your stop a few pips above the high here, it's so weak, and the currency meter told you to stay in it. Maybe you got out of the second half down here at 30 and made another 10 pips. So basically you got 25 pips on half, 35 on the other half. Your average exit was 30 pips. You risked 6 to 8. You made more than 3 times your risk. It's just a no-brainer way of trading with this range-based bars. And it also really allows you to see longer-term levels very nicely too. You could have a 25 range bar chart that from Sunday you can see all the times it moved up and down 25 pips, but it really was stuck in this 50 pip range. When it breaks down right here, you have just beautiful trends down. Here you have a nice decent pullback up, where when it breaks the trend line you go short again. The trend's down, so you're mainly looking to sell, not buy, but you have a small profit there. You also have another, just like I said before, you sold it here and you're up. If you're trading longer term off of this last trade, you have about 50 or 60 pips. We're all risking 20. So again, it's all about risk versus reward, and in my opinion, these are just absolutely amazing charts to help you do that.